Hey, everybody. So we have Tom Kuhn from AmeriFirst, and he's going to help us to try and hear. We've been hearing a lot of hubbub. And Mark, what's the hubbub about?
Well, the hubbub is about interest rates going up.
Yeah, interest
And I
rates.
think, and I
Yeah,
think Tom can talk to us a little bit about some of the options that people might have to make that higher interest rate we're looking at now a little bit easier to swallow,
right.
especially with the way the market's going as far as sellers being more open and likely to maybe help out a little bit, help the buyer with some concessions.
Yeah, that's a good thing about a balanced market. That's a good thing. We got more housing inventory, so we have more homes competing, we have more sellers competing, and it's a great thing. Now they want to compete by possibly looking at different options and maybe even seller concessions. So how does that look? How are you seeing that out there in the lending world, Tom?
Hi, well, Mark and Mel, I appreciate the opportunity to be with you today. For those of you who don't know me, my name's Tom Kuhn. I'm a loan officer with AmeriFirst Financial, and we can lend in throughout the United States. And we're seeing some good changes for both sides on the market today, as Melissa was saying, the more inventory is coming on the market. So what's that creating? That's creating more options for buyers. It's creating more competition if you're a seller. And so we're seeing a lot of trends coming to play that we've seen in the market before, that sellers can do, tools that they can use in order to better secure a contract and compete with their neighbors and selling a home. So as Mel was saying, the interest rates have increased, since 2012. We've been used to those 3% to 3.5%, sometimes below 2.875, 2.75 30-year fixed rate. Well, those days are gone. As you know, the Fed's been increasing the prime lending rate in an effort to curtail the growth of inflation. I don't know if it's working yet. I won't get into that, but we're faced with some rate increases. So right now, the 30-year fixed rate's been running. We were over 6. It actually has settled down to mid fives. And on a 15-year, you can get, at 5% or down at 4.75. Historically speaking, and Mark and Mel and I were talking about that because we've been in the industry for a long time. I've been in the industry since 1981, starting in real estate sales, and then I got into banking in 1999. But we've seen over our career 19% interest. So even 5.5% interest, historically speaking, if you look over a 20, 30, 40-year time period, anything below 6% is still a great rate. The other thing, and Mark was reminding me of this yesterday, whenever we go through these time periods when you'll see an increase in interest rates, after a while, after the economy settles down, whether or not we're going into a recession or a soft recession or whatever, historically, you're always going to get to a point where you'll have some better times and those interest rates will come back down again. I don't know if we'll ever get back down to that 2.75, but historically speaking, you will see those rates come down. This is a great chart that Mel has put up there. If you notice, there's 1981 and 82. We were just talking about that's when I built my first house at 19.5% interest. It was kind of scary, and it was adjustable rate mortgage. And when it got down to 12% a couple of years later, if you notice, it did start coming down there. And look at it, 1984, it was just above 12. So I remember when my rate got back down to 12%, I was just dancing in the street. That was really great. So
Yeah.
if you look at where we're at now, at a 5.5% or lower interest rate on a 30-year fixed loan, that's historically speaking still a very, very low rate.
Mm-hmm.
Now, one of the things that we wanted to touch upon is what can sellers do in order to be more competitive on the market and provide incentives for buyers to, contract to purchase their home. Now, one of the more important things, I'd say the key things, is you have to price it right. Those days of getting 50 offers on the house the first day you put it on the market and bidding up 50 or 100,000 over market, those are gone. You may see some bidding going on depending upon the property and how well it's priced. You may see multiple offers still, but that craziness it was almost unhealthy when it gets like that, because people start paying what we feel is over market value because they've got cash and they're not getting a loan, and they don't care what the competition says. They just want that house. They're going to get it. And so you're seeing less of that, sometimes none of that. And what you're seeing is you're seeing sellers, because their realtors have really put together a good comparative market analysis, they're putting it at a price that's going to sell it. And if they don't get offers in that first 30 days, you're seeing price reductions, because that's really what happens. If buyers are not coming through your home, you're overpriced, or something's wrong with the staging or something. If they're coming through your home and after 30 days you don't have any contracts offers, even if they're lowball offers, something's going on. And so you're seeing sellers starting to adjust their sales price down after a certain period of time. So key thing is price it right, get buyers in there, get an offer. But another thing that sellers are starting to do right now, which we haven't seen before, number one, they're looking at contingent offers. If somebody's selling a house in another state and they're moving here with a job transfer, you like to see that property in escrow if you can, but they're starting to look at contingent offers. They're also considering VA and the FHA offers, which for a time period they weren't doing. And one of the things that I've seen, in fact, this last couple of weeks, is sellers not only reducing their purchase price, but offering a seller credit towards the buyer's closing costs. Now, if for those of you who don't know, if a buyer's getting a conventional loan, a conforming loan, the seller can contribute up to 3% of the purchase price towards the buyer's closing costs. Now, that 3% can be used for appraisal, escrow and title. It can be used to pay their prepaid insurance, tax prorations, impounds. It can also be used to buy the rate down. And that's one of the things that we're going to go over today. Now, on an FHA loan, the seller can contribute up to 6% of the purchase price towards the closing costs. So that's quite a bit of money, So let's say on a $400,000 purchase on FHA, 6% of that purchase price is $24,000. The seller can contribute towards a buyer's closing costs, and they can use it because typically closing costs, if you want to just use a rule of thumb, and I'm talking about loan costs, escrow title, and everything, runs about 1 to 1.5% of the purchase price. So if you're getting a 3% credit towards the closing costs on a conventional loan, that's 2 points that you can use to buy the rate down. And for every 0.5 point that you pay towards a discount, you're going to buy that rate down by 0.5%. For every 1% discount fee, you're going to buy that rate down 0.5%. If you pay 2 points discount, you're going to buy that rate down a full 1%. So let's say you were looking at a rate today of 5.5% with no points. You could essentially, with a 2% discount, buy that rate down to 4.5%. That's a significant savings.
Is this messing you up? Should I stop sharing that screen?
No, that's good. No, just keep it up.
Okay.
Yeah. So this is an example that Mel put together yesterday. And, again, summarizing, a 1% reduction in rate buys an additional 10% in borrowing power.
That's
So,
amazing.
for instance, on a loan that's, let's say, $400,000 that you're qualifying for, if you got a 1% reduction in the rate, it allows you to qualify the same payment for a $440,000 loan. And so it gives you more borrowing power. And now, again, on this example that Mel's put on the board, there's a $500,000 purchase. So instead of the home seller reducing the sales price down to $485,000, the seller can contribute $15,000 towards the buyer's closing costs. And this is a big deal, especially to young buyers, first-time home buyers. And it doesn't matter if you're putting 3% down or if you're putting 20% down. It still is a help to the buyer. And so it's attractive to them. So again, the seller can contribute up to 3% towards those closing costs. And you actually want to put that in the contract because it has to go towards closing costs. Now, you can get into a discussion of, well, let's see, I want to buy drapes or I want to replace the floor coverings, Now you can get into those things, but Mel and Mark will tell you through their experiences, it's more complicated because you have to have the items installed before close of escrow. So then, there's liability issues with the seller. And, you have to have a bill paid through escrow. So it's just more complicated. So it's better for the borrower, we feel, to take care of whatever, your floor coverings or whatever you're going to do afterwards, and take that cash contribution up front and keep your money in the bank, and you can just pay that stuff cash, after the close of escrow. So now again, lowering the rate, her example here, the rate from 6% to 5% on a $400,000 loan would lower the payment from $23.98 a month. This is just principal and interest, not taxes and insurance, but $23.98 a month to $21.47. So that's a savings example of $251 a month to that borrower. That's a lot of money, $3,000 a year. So again, that's allowing that borrower for the same payment to qualify for 10% more in a loan amount. So that means a borrower could buy a $500,000 home instead of a $450,000 home. That's a big deal, especially in today's market. And again, down below there on the bottom, with FHA loans, the home seller can contribute up to 6% of the purchase price towards the buyer's closing costs. Now, that's a lot of money. I really haven't seen that big of a credit, but you see on FHA, you have much more flexibility. Now, in Maricopa County, your maximum FHA loan amount is right around $441,600 maximum. So that's going to buy you a $457,600 home with 3.5% down. So the buyer only has to come up with that cash to close, $16,000, and all of the buyer's closing costs, escrow, title, appraisal, prepaid insurance, property tax prorations, everything, including a discount to buy the rate down, can be included in that purchase price. Now, keep in mind, on both conventional, back to the down payment on conventional. Remember, for first-time home buyers, we can go as low as 3% down. For a second-time home buyer, it's 5% down. And naturally, you'd have mortgage insurance, or we can do lender-paid mortgage insurance. But again, the seller can cover all those closing costs. Now, for some buyers, and I always point out to young people, if they don't have the cash down, naturally we can look at down payment assistance programs. Those are a little bit more costly and higher rate right now. But sometimes they don't realize that to put that down payment together, they can, if they're working and paying into a 401k, they can borrow that money from their retirement account. It can be a gift from a relative, grandma, a mom and dad. It used to be in the olden days on conventional, in order to use a gift, from mom and dad, it had to be 20% down. Well, those days are gone. If they're putting 5% down, it can be gifted from mom and dad or grandma. Same thing on FHA. It can be a gift. So with these rates the way they are, and with young people, all the greatest thing about what's going on right now is the balancing of the market and getting buyers more opportunity, but also there's tremendous employment going on right now.
Right.
Most of the loans that I'm doing right now are people that are job transfers from another state, and they're coming from everywhere. They're coming from, a lot of them from California for a number of reasons. We don't need to get into the politics, but for a number of reasons, they're coming from California. They're coming from Illinois. They always come from Ohio and Kansas and Michigan. And
Too cold there.
it's cold there, but they're coming, from Texas, so tons of jobs happening right here. I talked to a buyer today. They're moving from Illinois, and her husband already got it. He was in construction with Cook County. He was like a construction manager, but he got on with the state here in construction management. And his wife's a school teacher. She's already turned down 5 offers.
Wow.
I mean, there's such a demand for school teachers. It's like crazy. So she's negotiating their salary up because, back there in Illinois, they were paying higher. So she's still looking, but she's already got like 6 or 7 offers that she hasn't accepted. So there's great things happening out here with employment. But the whole point is of our meeting today is we want to talk about there's options for buyers because there's more opportunity. There's more homes to look at. Sellers are now pricing them aggressively, and then we can add these seller incentives to help lessen the cash to close for that borrower and buy that rate down.
Yeah, it's awesome. It's great news. It's actually a really good market. And, for Arizona, I mean, it's all about location, always has been about location, right? And
absolutely,
and we're pretty buffered here when it comes to jobs and a balanced market coming, to most areas. And so we've got even some new home builders out there that are trying to get business back because all of a sudden buyers said, well, I can go get this house right now, this resale.
Yeah.
I think the moral of the story here today might be there's not to get worried about this 5.5%, 6%, maybe even if it tips up to 6.5%. That's lower than the average over the last 30 years or so. Average rates over like the last 30 years have been over 7. So this is not catastrophically high.
Right.
Plus this also, the situation, as you just described, presents all kinds of creative opportunities for sellers to get involved with the buyer and maybe buy that rate down or pay down the closing costs or otherwise. And the one thing, and I haven't really touched on it yet, but I imagine you'd agree with me that that interest rates, as we talked about earlier, come down historically in a couple, 3 years, sometimes a little longer after they shoot up. So these buyers, no matter what they do on the front end, even though they might be paying a higher than 6 months ago's interest rate, they probably have a great opportunity to refinance 2 or 3 years down the road at a lower rate.
Absolutely. Yeah. Historically, every time the interest rates go up for a certain period of time, at some point in time when the economy everything gets smoothed out and this inflation gets back down to normal, those rates will start getting back down. And, typically once you see it get down to at least, a 0.5 or 1% below what your start rate was, then it makes sense to refinance. So, and it always happens. It always comes back down.
So one other thing I would add, excuse me, Mel, is
no, go ahead.
We're talking mostly about interest rates and financing now, but there's a lot of people out there that have this idea in their head that, well, now that interest rates are going up, I'm going to just wait for home prices to come down and buy then. That is not going to happen, not in any time in the near future. home values are still continuing to rise, just not as fast
Right.
as
That's
they have
correct.
been recently.
Right.
And waiting will, in almost every single case, cost a buyer more.
Right.
That's right. There's still so much more demand than supply. The
Right.
supply is starting to get a little bit more balanced.
Right.
But the great thing about, especially what's happening in Arizona, where we're located, is there's tremendous job opportunity. That people can't hire enough people. And I went to a U-Haul today down the street where I like to fill up my propane gas because we're going to go camping the next couple of days, you know. And I had to sit there for a half hour and wait for one of their employees to come over and fill it because they were just so busy. And I asked the manager, I said, "It was always like this?" And she goes, "I can't keep enough help." She says, "We got the hire sign out there constantly,
Wow.
but I just can't keep enough help." So there's jobs out there, and that's a great thing that for our economy for sure.
Yeah, it is. Well, I really want to thank you for explaining that a little bit more, because it is a great program that home buyers can use, as well as home sellers can use as incentive to get their home sold. And it seems like we're all just working a lot better together now again, as home sellers
Absolutely.
and home buyers. We're all just negotiating, and things are a lot less, like you said, frenzied, and it is a good market to still home sell and home buy. And with people that are taking good care of you, it's very important to talk with your lender, especially if you're moving here and relocating for a job, because the lender is going to tell you what to do so that you can still pre-qualify for a home purchase when you get here. So talk to the lender. Tom is available. Can you give your name again?
Yeah, again, it's
your
Tom
number?
Koon, Koon. My cell phone is 602-818-7323. So give me a call. We'll get you pre-qualified right up front, so you know what you within 30 minutes, I can get you pre-qualified, get you an itemized cost sheet, so you know what your closing costs are, you know what your buying power is. So you've got a pre-qualification to hand to Mark and Mel and go start looking at houses.
Awesome. And we're always here for your questions too at 480-462-7355. You can talk to Mark or myself. My whole team here is ready for you. Been in the industry over 30 years, marketing and appraising real estate, and we love helping all our clients. So we'll talk to you later, Tom.
All right. See you later. Thanks so much.
Thanks,
Thanks, Tom.
everybody. See
Appreciate your
y'all
time.
later.
All right. Bye-bye.
Take care.